Hey guys, I'm Zeke,
And I'm Brian.
and you're watching Two Guys Talking Home Buying.
Thanks for joining us. This is a new show for us. And the main thing here is home buying, like Zeke said. We're going to get really deep into a bunch of topics, and we're just going to make sure that if you're buying a home, you're getting a lot of great information, things that can help you get a better rate, get a better loan, avoid some frustration as you go through trying to find the house, avoid some frustration as you go through the escrow process. And so we're just going to cover a lot of things, and it'll be really helpful for you if you're a new home buyer. And so Zeke, tell us, what is your home buying experience?
So I have nothing. I'm a complete newbie. But this year I plan to buy a house, so I do have some questions that you guys might have as well. And Brian over here, he's super experienced, so that's how this kind of whole show came about.
Zeke's our video director, or social media director, so he's usually like on the other side. But being that he's new to buying a home, he thought it'd be cool we get on camera and just go through some topics that would be great for you. Like I mentioned, my name's Brian, and I'm the co-founder and the president of Showcase Agency. We're a real estate and mortgage company. So we help people to buy homes, sell homes, help them to get the home financing. And I started the company back in 2017 with my wife, Karen. Karen's been a licensed realtor since 2001. I've been licensed in mortgages since 2005. So between the two of us, we've got like 36 years of combined experience. So we're going to be sharing that with you guys today on the show. And let's go ahead and
go into today's topic, right?
What's the topic?
It's going to be BS home loan fees.
Okay, so BS fees. So we're talking about junk fees. We're talking about bull S fees. So these are the fees that you don't want to pay. So we'll go ahead and hop into it. What's the question you've got?
First one I got is, how many fees are there in total? How many do you think is that?
So there's a lot of fees. You're going to have escrow fees, title fees. There's going to be recording fees with the county. And that's not just like one recording fee. There's usually 2 or 3 recording fees. And you're also going to have, if you get a loan, which most people do, you're going to have lender fees. Those are things like appraisal, could include underwriting, could include processing. So what did I say? Lender, escrow, title, recording. And then you'll also have what's called prepaids and impounds. And we were talking a little bit, before the show started. And prepaids and impounds are, like I mentioned earlier, these are fees that they're not really fees, they're amounts that you're paying in advance. So there's lots of fees. What I did is I grabbed 3 statements, 3 closing statements from 3 recent purchases. We've got a purchase at $410,000, a purchase at $495,000, and a purchase at $475,000. And so we're just going to kind of like do a comparison here. And but just to show you, here's all the fees that are on here. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. 31, 32, 33, 34, 35. So this one's got like 35 fees.
35.
Yeah.
Wow.
But they all fall into these buckets.
Okay.
Right here.
Okay. Awesome.
So 35 or so fees.
That's a lot of
fees. That's a lot. So now, you mentioned BS fees, so we're kind of talking about the fees that you shouldn't pay, right? Or
yes,
the fees
correct.
that you may not have to pay. So back in 2007, 2008 or so, the federal government, because the global economy, the global economy did collapse, and at the root of it was the United States housing market. So the houses and the mortgages that were on those houses were the cause of the entire world being in a mess financially. And so the U.S. government felt like part of the reason that those mortgages were so bad for the people that got them was because the fees were so high. So there used to be a really, really common hidden fee called a prepayment penalty. Have you heard of a prepayment penalty?
I have not. I don't know.
All right.
What that is.
So it's kind of just like it sounds. If you have a loan that has a prepayment penalty, what that means is that if you wanted to pay that loan off early, they would charge you a fee to do it.
What?
Yeah, so that's a prepayment penalty. So that was more like a hidden fee because you didn't pay that fee when you got the loan, but you paid that fee to get out of the loan if you were trying to get out of it early.
What?
So a real common would be what's called a 3-year prepay.
Okay.
So a 3-year prepay might be like 2%. So what that means is that if you want to get out of the loan anytime in the next 3 years, 3-year prepay, then you're going to have to pay 2%. So if that loan was $400,000, you'd have to pay $8,000 to pay that loan off early. Just to pay your own loan off early.
Right.
Yeah. So prepayment penalties are a big example of BS fees and junk fees, but they mostly don't exist anymore. And the reason is because in like 07 or 08, the federal government stepped in with this legislation called the Dodd-Frank Act, named after two of the congressmen or representatives or senators, whatever they were in Congress. And so you had Dodd and then Frank, and the two of them put this bill together, thousands and thousands of pages, very boring stuff, but it did a lot of great things to protect the consumer. At the time, it was a big deal in this industry, in the mortgage industry, because it cut the amount of commissions that the mortgage company could make. So the mortgage companies, they didn't like that because it cut their commissions. It limited how they could get paid. But for the consumer, a lot of good things happened. There were a lot of disclosure rules that came about so that people wouldn't get... So like one thing that used to happen before Dodd-Frank is a person buying a house might be promised that things are going to be might be promised that they're going to get a certain rate and a certain type of program.
Okay.
And at the very last minute, they might the lender might switch it on them.
What?
And they would do it right at the closing table. So in other words, the person is got to sign today.
Okay.
They might even have to be out of their apartment. They might even have their furniture loaded up in the moving van. So their back is against the wall. And some lenders would say, "Oh, I know we told you it was going to be this, but it's going to be different," and the person doesn't really have much of a choice, right? So they would just go ahead and sign. Yeah. So Dodd-Frank stopped that from happening. Now there's a 3-day cooling off period. You get a disclosure called a closing disclosure, and then you've got to wait 3 days before you can sign the final paperwork.
Gotcha.
And so that 3 days gives you a chance to, if you've got questions or concerns, you can get your questions and concerns answered. That you're not being forced to
Do it that day.
Yeah, do it that day.
Wow.
And another thing that was really cool about Dodd-Frank, and this is sort of related to fees, but it's more related to Dodd-Frank, is that Dodd-Frank also limited limited the amount of interaction that the lender could have with the appraiser.
Okay.
And so that prevented these situations where lenders and appraisers were buddies and things were getting valued at a certain level that shouldn't be valued so high.
Yeah.
So that's another thing that happened because of Dodd-Frank. And there's lots of other good things, limiting the commission, limiting a lot of these fees, called the prepayment penalty. And then another thing that happened is they came up with fees that can't change. So that was another thing that used to be bad before this whole Dodd-Frank thing, is a lender might say, "Oh, your fees are going to be $1,000," and then you get to the closing table and your fees are like $5,000. And now the way that the loans are set up and everything, you can't actually change the terms on the person. So, so as a buyer, you don't have to worry about the lender being able to just flip these things around on you, because that's not allowed anymore because of Dodd-Frank. So kind of a lot, so to sum all of that up, a lot of the BS fees, the junk fees, a lot of those fees, they don't even exist anymore, thankfully, because of this legislation from 07 or maybe 08. So now what you want to look at is well, out of the fees that are charged, how much should I expect to pay, and what's reasonable, and then also what do you have any control over, right? So like some fees you don't have any control over, like you can't tell the county recorder's office, I don't want to pay $50 if that's what their fee is to record the deed. Yeah. So so some things you don't have any choice on, but some things you do have choice on. So that's something we can talk about next, because if you're watching this and you're going to buy a house this year, one of the things that's going to probably be important to you is how much money that you have out of pocket. And so the money that you have out of pocket is a combination of your down payment and your closing cost, and then if you've got any kind of credit that's coming to you, credit could come from the seller, it could come from the agent, it could come from the lender. These are all different places a credit can come from. So your money out of pocket is basically going to be your down payment, your closing cost, and then minus any kind of credit. And
credit is money towards you, right?
Credit would be money towards, would be, think of it like if something was credited to you.
Gotcha.
So if I'm crediting you $2,000, it's like I'm giving you $2,000.
Nice.
Right?
Nice. I didn't know the agent could do that.
Well, there's different situations, there's different things that can happen. So like we've got a deal here where the seller actually credited $4,385. So sometimes that's part of the original negotiation. Sometimes that's part of renegotiation. That's what happens when you get into a situation with a request for repairs, for example. You get, you have a home inspection maybe, and the inspection has a bunch of stuff that's called out, and so you might you might renegotiate with the seller to get a lower purchase price. But you're better off if you. So this is a viewer tip. This is a really good thing to know. If you're given an option between the seller taking $2,000 off the purchase price or the seller giving you a $2,000 credit, which one would you take?
The purchase price, right? Because it's lower.
Wrong.
No?
Yeah, absolutely wrong. So well, I mean, neither one of them's. I can't say one's wrong, but so if you get $2,000 taken off your purchase price. Okay, $2,000 off your purchase price, and your down payment. Let's say your down payment is 3%, right?
Okay.
Might have broke my calculator. Hang on. 2,000. So what you just saved yourself out of pocket is $60. You follow me?
Yeah.
Because they gave you $2,000 off the purchase price, but you're not paying $2,000 off purchase price. You're paying a percentage of the purchase price, right?
Okay.
So that saved you $60. Now, if they give you a $2,000 credit towards your closing cost, that's like a true $2,000. So let's say that it was going to take $20,000 to close.
Okay. And
now they're giving you a $2,000 credit, and you choose to take it as a credit towards your closing cost instead of off the purchase price. Now your $20,000 cash to close is only 18. Exactly.
Awesome.
So this way you save $2,000. The other way you save $60.
Awesome. And then when the seller does give out that credit option, you have the option to put it towards your closing costs and purchase price, or they just
no. Great question. So this is part of the negotiation that your agent would do on your behalf.
Gotcha.
So typically you and your agent talk over strategy, what you want to accomplish, how you could go about getting those results. You and your agent talk that over, and then you come up with what you're going to do, and then the agent executes that for you. The agent goes out and represents you in the negotiations as the buyer. Now, the difference can be sometimes people that are buying a home will not get their own representation. Sometimes they'll use the listing agent. So the listing agent selling the house, they can also sometimes write up the offer, or I shouldn't say sometimes, they're allowed to write up the offer if they want. Sometimes some agents won't do that. Like we won't, so like if Karen's listing a house, she won't write up the offer for the buyer because she feels that you can't, there's no way you can represent both sides.
Yeah, that's kind of,
you know, like it'd be like if you were on trial and you got one attorney that's trying both sides.
Yeah.
You know, it just doesn't work. So, you know, that's something to consider too if you're thinking about using the listing agent. Sometimes people use the do you know why people like to use the listing agent?
I wouldn't know.
But you understand what I'm saying, right?
Yeah.
Somebody's got the house listed for sale. Got it. So sometimes the reason people like to use the listing agent is because they think it's going to get their offer accepted. They think it's going to, because
he's on their side, or she is
no,
on their side?
because the listing agent is going to make 2 commissions now. The listing agent is going to make the listing commission, but they're going to make the buy side commission too. So they probably just like doubled or almost doubled their commission.
Okay.
So if I was the listing agent and I can work with this person and make a $20,000 commission, or I can work with this person and make a $10,000 commission, a lot of times the listing agent will be biased towards the bigger commission, whether or not it's a good deal for the seller or not. Yeah. So if you are represented by your own agent, it's not a listing agent, you've got your buyer's agent, then that agent is going to go back and negotiate that. And you might negotiate because the inspection might be completely different from what you expected, and there's a bunch of repairs that are due or needed. Another thing that might happen is the appraisal might come in short. So the lender gets an appraisal done. The appraisal might come in for less than the purchase price. That might be a reason to go back and negotiate. But so those are some different reasons. But that's how it would work. If you have your own agent, you and your agent would discuss it, and your agent would execute.
Their agent.
Yeah, the agent would be your go-between as the buyer. Yeah.
Thanks for that.
Yeah, absolutely. So we just did a little history lesson about the fees, and the good news is if you're buying a home, a lot of these they were called predatory lending fees, junk fees, BS fees, and they were just fees that really were nothing, and people and the lenders would just add them to the loan. So you'd have a fee here for $100, but it was just a BS fee. Here's a fee for $75. They would just add fees on, and nobody would really question them, or they would give them official sounding names or whatever.
Gotcha.
But the good news is you don't have to worry about that. So let's talk about those fees that you can control, and the fees that you can't control.
Awesome.
Which one you want to talk about first?
So let's do the ones that you can't control.
Can't control.
Okay.
Great choice.
Right there.
So the fees that you cannot control, one is going to be your impounds.
Okay.
Do you know what impounds are?
I don't.
Okay, cool. So impounds is the amount of money that the lender requires you as the buyer to set aside into a separate account that's held by the lender, so you don't have to go out and open up an account or anything. But the lender is going to set up an account, and they're going to hold money in that account, and the purpose is so that when your property taxes come due, you as the buyer don't have to come out of pocket like thousands and thousands of dollars, because you've been including it in your mortgage payment every month. And then so like if your property taxes were estimated at $200 or $2,400 a year, that's $200 a month. Okay, so the lender is going to put $200 into your mortgage payment. And so every month you're going to make your regular mortgage payment. Well, when they get your payment, they're going to take that $200 and they're going to put it into a separate account and let it just keep piling up.
Okay. Nice.
Then when your taxes come due, they're going to have a big chunk of money in there. They're going to write a check for the taxes, and you're going to see that account balance for your impounds. You're going to see that balance go down because they just wrote a check for that.
So pretty much they're kind of just saving it for you? Is that
exactly? Yeah.
Okay.
So it's called impounds. And it refers to your property taxes and then also your homeowner's insurance.
Okay.
So typically people are gonna, it's called impound, and sometimes it's also referred to as escrow. Escrow is a very confusing term because it's used 4 or 5 or 6 different ways in real estate. So I like to stick with impounds. And if you put enough money down on your loan and you get a conventional loan and your credit score is high enough, then you can choose not to impound. Okay? And what that means is you're not having money set aside each month. So now what happens is your payment's lower, your monthly payment's lower, right? Because you're not putting money aside for your taxes and your insurance. But when your taxes come due and when your insurance comes due, you've got to pay it out of your pocket.
So now you got to come up with all that money up front.
You got to come up with all that money. Now the reason that it's not an option for most people, so if you're putting 3.5% down on FHA, that's not an option for you to skip impounds. Okay. If you were putting 3%, 5%, 10%, maybe 10%, I don't know, 3 or 5% down on a conventional loan, you cannot skip impounds. And the reason is because if you get behind on your property taxes, do you know what happens?
I don't know.
You get a tax lien. Do you know what that is?
I don't know.
So that's basically where the government, county government, will say, you know what, this guy here at this that owns this house, he or she hasn't paid the taxes on the house that are due, and the taxes are $5,000. So they put a $5,000 lien on the house. Now, if you don't pay your taxes, and it's different from state to state. Here in California, this is how it works. If you don't pay your taxes, then the tax lien can foreclose on your house. So you could actually be making your payment on your house okay, but you're not paying your property taxes. Okay. And you could lose your house because of that.
Wow.
The lender doesn't want that to happen because that's their collateral, right?
That's their money.
That's their safety net if you don't pay. So they don't want that to happen where now all of a sudden their collateral is risked by this tax lien. Okay. So that's why they typically require you to what's called impound.
Do the impounds.
Yeah, that's why they require it. Yeah.
Awesome.
But if you put enough down and your credit score is high enough and you go conventional, then you can skip it if you want. Okay. Some people like to skip it. Awesome. So that's a little bit about impounds. There's really nothing you can do about impounds. That's why it's one of those fees you can't do anything about. If your property taxes are $5,000 a year and they're going to come due in February, there's nothing you can do about that. And the lender is going to adjust how much money you need for impounds based on, when the taxes are due or whatever. Okay. Does that make sense?
Yes.
Any questions on impounds? That's kind of property taxes and
nailed
insurance.
it. I think that's good. And then what are some other ones?
The second one you can't do anything about. Prepaids.
Prepaids. Okay.
What do you think prepaids are?
I don't know. I don't know.
No worries. So prepaids are basically, you know what this is like? We talked about this the other day. So in case you guys, if you're thinking of buying a house this year and you didn't know this already, when you close on the house, let's say that you bought a house this month, you bought a house in January, just like Ricky and Anna who are closing. Mm-hmm. So let's say that you bought a house in January, you would not have a mortgage payment for February, your payment starts up in March. Does that make sense?
Yeah, I think, might have
now,
mentioned that. It's nice they have that gap.
Yeah. Now your March payment, you pay your interest in arrears. Do you know what that means?
I don't know.
So when you pay your March payment, you're not paying for March. You're paying your interest for the month before. You're paying your interest for February.
What? You're like kind of doing it backwards? Working it backwards? Or?
Yes, it's one way to look at it. Yeah. So when you close on your home, there's a period of time where there's unpaid interest. So if there's 30 days in the month and you closed on your loan on the 10th day of the month, how many days are left in the month? 30 days in the month, you closed on the 10th. How many are left?
20, right?
20 days left, right. Okay. So there's 20 days of interest that's due to the lender. Okay. So if your loan is costing you, $30 a day in interest, and you had 20 days of interest, that's $600. So that $600 of prepaid interest is just part of the loan. So
Gotcha.
again, there's nothing you can really do about it. The higher your interest rate, the higher that days of interest, the higher your loan amount, the higher that days of interest, but there's nothing you can do about it. It's just a part of the loan. A couple of other groups of fees that you can't do anything about: title fees and escrow.
Okay.
And so escrow is the company that is going to handle all the money. They're going to handle all the loan paperwork. They're going to assign all of the notaries and make sure that everything that's supposed to be notarized is notarized. If there's something that has to get overnighted or a courier, they're going to schedule all of that stuff.
Mm-hmm.
So they're kind of like the hub of this whole escrow process.
Mm-hmm.
So that's another, like I was saying, escrow is used like 4 or 5 different ways. So you've got an escrow process, and then there's also an escrow company. You have an escrow officer. That's the person. Yeah, there's a lot of escrows. It can get confusing. So, so escrow, they're doing all these different things and just trying to make sure that everything's going along smoothly. And they're also our go-between typically with the title company. Okay. And so you've got escrow fees and you've got title fees. So over on the title fee side, the lender is going to require that there be what's called lender's title insurance. So the title of a house is just like the title of a car, right? So it tells who owns the car. The title says who owns the house. And if you own the house, like if you bought the house, but you bought it with a loan, then both of those pieces of information are going to be in that title report, that chain of title.
Gotcha.
You're going to be able to see who owns the house, but you're also going to be able to see if they took out a loan for it. Does that make sense?
Yes.
Yeah. Yeah. So there's a title company that provides title insurance, and the purpose of title insurance is to make sure that the title to the home is clear, is clean and clear. If something was missed on the title, like let's say that example about the property tax, like somehow if a tax didn't get paid and there was a lien on title, or I put it this way, like let's say that you had some work, or let's say that the seller of the house had some work done to the house. Okay, and they didn't pay for the work. Then the people that did the work may put a lien on the property, and that lien is called a mechanic's lien. It's just a lien for work that was done, but they weren't paid. So that would report on like a chain of title. Okay. So what's important, the reason for the title insurance, let's say that the person that was doing the title report, let's say that they missed that mechanic's lien. Okay. Well, then the house changes hands. The new buyer, you buy the house. Mm-hmm. Well, now the person that had that mechanic's lien, they come to you and they want their money
after me, even though I didn't.
Because it's your house. Yeah,
wow.
yeah. And you're doing that unless you got title insurance. Title insurance, that's what covers it. Is any kind of they call it defects on title, and there's cloud. I forgot what all the terms
I want
are.
that.
Well, you have to get it.
Oh, you have. Okay.
Yeah, you don't get a choice.
Awesome. So that's good. That's really.
You don't get a choice. That's going to be part of your title fees. So title fees on this one were $799. The purchase price was $410. This was an investment property. The buyers put 25% down because it's an investment property, but the title fees were only $799. Title fees here are $966.
Okay.
This is a $495,000 purchase. Not an investment property. And then this one's $475,000 purchase with title fees around $1,295. So you got $1,295 on down to like $800. So $800 to $1,300 is like your title fees, and then escrow fees are another block of fees. Mm-hmm. And that's going to be a kind of like a service fee. They call it an escrow fee. And then you might have a few other fees in there. Escrow fees on these are running anywhere from, wow, that one's expensive. Escrow fees on this one, $2,800. Escrow fees here, $2,100.
And that's how much they average around there?
And then this one's $1,600. Yeah, so this one's not quite as bad as I thought. So about $1,600 to $2,800. So about $1,600 to $2,800. So that's your escrow fees, and you don't really have any say-so over them. The seller of the property is the one, or the seller's side of the property is the one that chooses the escrow company. So you don't get to say, oh, I'm the buyer, I want to work with a certain escrow company. You can ask, but it's probably not going to happen. And it's customary to just accept whatever the seller is working with. So unfortunately, if the seller or the listing agent has chosen a escrow company that have, you know, slightly higher fees, then there's nothing you can really do about it.
Wow, I didn't know that.
Yeah. So those are kind of all your fees that you really don't have any control over. So there's no reason really to stress over them. Mm-hmm. The one last thing I'll point out, unless you got a question, but the one last thing I'll point out about these fees that you can't change is understand which ones you can't, understand what these fees are, so that if you're getting quotes from a couple of different, let's say you're getting quotes from 3 lenders and you want to look at like apples to apples comparison, what you want to do is like strip away all of the escrow fees, title fees, prepaid interest, impounds. You want to get rid of all of that stuff on the quotes that they send you. Okay. And so that you can just compare the lender fees and the interest rate. That's what you want to look at, lender fees and lender fees.
Those are the main things.
Yeah.
Awesome.
Yeah. Any questions about the stuff that you can't really do anything about?
I think I'm all good on that.
All right, cool. So let's hit.
What are some things that you can change?
Well, lender fees is pretty much the only one that you really can. And so lender fees are going to be the fees that are associated with getting the loan. Okay. Now, to get the loan, you can go through a mortgage broker. That's what we are here at Showcase Agency. So you can go through a mortgage broker, and what a mortgage broker does is they have access to lots of lenders. And so, you know, they might, you know, so they can maybe pick a lender for you that is fast, and you might need a fast lender because of that's what it took to get your offer accepted.
Gotcha.
Or they might, or as a mortgage broker, we might place your loan with this lender over here, and the reason we do that is because they allow us to go with a low credit score, and you've got a low credit score. Or we may place your loan over here with this company because you've got a high credit score, you know, so whatever. So a mortgage broker has some options. Another choice that you've got is to go with a bank. It could be a credit union. I'm sorry, it could be just a regular deposit bank like Chase or Bank of America or whatever, or it could be what's called a mortgage bank. A mortgage bank is a bank that lends money, but they don't do checking accounts, savings accounts, and they usually don't have like a storefront. You know, usually do everything online or whatever. Really? Yeah. So that's another type. When you work with a bank, typically they're lending their own money, and they have their own set of guidelines. And so if you as the buyer fit in their little, you know, box of guidelines, then they might have a great program for you. But if you're a little bit outside of that box, then you may not even be able to get a loan there, but you could go somewhere else, maybe get a loan. And the other one's a credit union, and a credit union is going to be similar to a bank a lot of times in that they're lending their own money. So my point of all of this is if you're getting all of these different quotes, if you're getting 2 or 3 quotes, it's likely that they're going to look a little bit different from each other, and that can be kind of confusing. So what you want to do is you really want to focus on the lender fees and your interest rate. And so lender fees, whether it's a bank, a credit union, or a mortgage broker, lender fees are a lot of times are basically going to be like your appraisal. Okay, so we've talked about appraisals a bunch on our short videos. And if you haven't seen our short videos, please check them out over on Instagram or Facebook. But we do a lot of short videos. We talk a lot about appraisals. And appraisal fees anywhere from $600, you know, like I think one of these is, this one's like this one's $500. This one's high on this one. This one's $1,000. Do you want to know why that was so high?
Yeah.
And
it's
then
like double.
And then this one's $675. Yeah, so on this one, it's an investment property, and those are, and it's a 2-unit property. So there's extra things involved that make that. So you're going to have an appraisal. It's probably going to be $500, $600, $700. The lender may require you to pay for a credit report. That could be, $50, $100 for 2 people, $50 for 1 person. The lender might ask you to pay for an underwriting fee. A lot of times that's around $1,000. A lender might ask you to pay for a processing fee. A lot of times that's around $500. So there's these different lender fees, and then they might have some of these other, like a little, they might have what's called a tax service fee. They might have a flood service fee. So they might have a few other little fees that might add up to like another $200 or $300. So one lender might have, $1,700, $1,800 in fees, and another lender might have zero, or might have like $500 in fees.
But then you go back to that main point where you have to compare those two things.
If your interest rates were the same, then the one with the lower fees would be less costly. Gotcha. But if the rates aren't quite the same, and if there's a big discrepancy in the fees, then it gets a little harder to weigh out.
Awesome.
Yeah. But so your lender fees are the ones that you can. You can do something about the lender that you work with. Basically, you can choose a lender that isn't going to charge you a bunch of fees, or you could maybe go with a lender that does charge the fees, but maybe they're just getting you a super low rate. Awesome. Or whatever, or they're filling some other kind of need that you've got.
And you mentioned that you had access to all these lenders, right? To get.
So any mortgage broker is going to be able to connect with thousands of lenders.
That's good.
That doesn't mean that there's literally like thousands of different programs. Everybody has got FHA, everybody's got conventional loans. So all these lenders have a lot of the same stuff. So it's not like there's really thousands of choices, but there's definitely choices for people that have low credit. There's choices for people that need down payment assistance. There's choices for people that have high credit. There's choices for people that maybe don't have traditional documentation, like they might need to do something with an I-10 number instead of a social security number, or they might need to use their bank statements instead of their W-2s. So when you get into all of these weird situations, or the low credit score situations, or down payment assistance, sometimes the banks and the credit unions won't have all of those programs.
Wow.
Yeah.
So many ways you can kind of go about this. So
yeah. So what I would say on this is when you're getting these options, just don't think that just because this guy has no fees, no lender fees, that it's better than this one over here that has fees. But it doesn't mean that it's not better. But you have to weigh that out. Usually the easiest way to do it is to take a look at. Let me mention this real quick. So discount points and lender credit. These are the last couple of things we definitely got to cover. But what other questions you got?
I was just going to have which fees you pay first, but I'd rather hear on
that's a great one. We'll come back to that one. So discount points and lender credit. So discount points is part of your lender fees, but I set it out separate because not every loan has discount points.
Okay.
So what discount points allow you to pay a fee in advance to get a lower interest rate. Makes sense, right?
Yes.
So in other words, if you are paying no fee, maybe you get a 2.5% rate. Okay, or let's say 3%. And then if you do pay a fee, let's say you got a 2.75% rate. Okay.
Yeah.
Which one's better for you is going to depend on a few things. If you don't have a lot of extra money to put towards your money out of pocket, you're probably not going to want to pay discount points, right? Because that's just going to be more money. Also, if you're not planning on keeping the loan or the house for enough time, and we'll talk about that in a second, but if you're thinking oh man, I'm going to keep this house like 2 years and then sell it, the discount points, it'll get your payment down, but you may not save enough money on the monthly payment to cover the money that you came out of pocket on. Does that make sense?
Gotcha. Yeah. So that wouldn't even make sense if you would.
Yeah, but some people don't think about it.
Gotcha.
They just go with whatever, so they don't think about it. So if you were going to sell in 2 years, that means you're going to have like 23 payments, right? You don't get the payment the first month, and then you get payment, for 23 months. So you've put in 23 payments. Let's say that the discount points going from a 3% to a 2.75. Let's say it saved you $200 a month. So that's $200 over 24 months, or 23 months. So now we're at $4,600, right? So you've got $4,600 in savings over those 2 years. Mm-hmm. Well, if it cost you $2,000 in discount points, that's a good deal. But if it cost you, $5,000 in discount points, it's not a good deal. You're at a loss because you're out of the house in 2 years. Gotcha. But if you're going to be in the house for longer, like this is your forever home, you're like, I'm never going to get out of this house. I'm going to keep it forever. I'm going to pay it off. Then you definitely want to look at discount points. If this is going to be like your forever house and your forever loan, mm-hmm. then you want to do everything that you can to get the interest rate down in the beginning if you're not planning on refinancing that loan or selling the house or anything. Gotcha. Does that make sense?
So you got to know what you want then.
Yeah. You got to know, got to give it a little bit of thought. What you don't want to do is you don't want to pay a bunch of discount points, mm-hmm. and then you end up like refinancing out of that loan in a year or 6 months or whatever, or you sell the house in 2 years or whatever, and then you just kind of wasted the money on the discount points. Gotcha. So discount points, guys, discount points allow you to prepay. It's basically an extra fee, so that means your money out of pocket goes up, but your payment goes down because your interest rate goes down. This is that mortgage rate seesaw that we've talked about before. So that's discount points. Discount points are controllable by you as the buyer, right? Because if you don't want discount points, then you don't have to pay them, but that means that you're going to have a higher interest rate.
Gotcha.
Lender credit. Let's talk about lender credit. Do you know what that is?
I don't.
Okay, cool. So lender credit is the opposite of discount points. Lender credit is where instead of it costing you money for a certain interest rate, a certain interest rate is actually paying you money.
Really?
Yes, absolutely. Now that money can be used towards your down payment. Cannot be used towards your down payment. That money can be used towards your closing costs. Okay?
Yeah.
So if you had $6,000 in closing costs and you had a $4,000 lender credit, now you've only got $2,000.
That's nice.
Yeah. So let's say here's where it can be really big. Let's say that your down payment is $15,000. You got to put $15,000 down no matter what. That's the minimum amount required by the lender. Okay, let's say it's $15,000. Gotcha. And then let's say your closing costs and your impounds and your prepaids, all the stuff that we just talked about. We're just going to call them all closing costs. Let's say that's $15,000. So now we got 15 and 15, so we got $30,000. Okay. If you had a $10,000 lender credit, now it's $20,000 instead of $30,000.
Nice.
Yeah, so it can make a big difference.
$10,000.
Yeah, you can say, but what's your trade-off though? The trade-off is the rate's higher.
Oh, right.
And the payment's higher.
That.
Right?
Yeah, so now you got to pay a higher payment every month.
Pay a higher payment every month. Yep, exactly. So that's why you want to look at it and you want to say, okay, I can come out of pocket $10,000 more and get a lower payment, or I can get this $10,000 credit and have a higher payment. You just have to do the math. You have to look at it and say, well, how long do I plan to be in this loan? What are my options? For a lot of people that buy with an FHA loan, we do a two-step program. Okay. The first step is to get them into the house with the lowest amount of money possible. And FHA loan is a lot of times the best option for that because there's only a 3.5% down payment, but you can get these really big lender credits, okay, that you can't get with conventional loans. You get them with FHA loans. So with the FHA loan, we might put somebody in a higher interest rate because that gets them a big credit and all they have to pay is like their down payment, right? Then once they've been in that loan like 7-8 months or so, then we'll look at, can we refinance them into a loan that's got a lower payment and then take whatever closing costs there are with the refinance. And the closing costs of a refinance are much, much less.
Gotcha.
So take whatever little bit of closing costs there are and roll them into the new loan, so you don't
Have to pay out of pocket.
have to pay out of pocket for those closing costs. When you purchase the house, you have to pay out of pocket for the closing costs, or you got to get a lender credit, or you got to get a seller credit, or whatever. But for the closing costs when you purchased, not only are they higher, but you can't roll them into the loan. When you refinance, if there's enough equity there, and there usually is, where you can roll the closing cost into the loan. So sometimes we'll do a two-step program where do a FHA loan to get them into the house with the lowest amount of money possible, and then 6, 7, 8 months, maybe 12 months later, we'll look at getting them into a different loan. With some of these neighborhoods that have gone up really fast in appreciation, when we've taken them into the second loan, sometimes we're able to take them from FHA straight into conventional, and with no mortgage insurance, or maybe just a little bit of mortgage insurance.
Oh, that's nice.
Yeah. So that's lender credit. So that's how the lender credit works.
That's amazing. Adam?
Hey Zeke, what was that question you had?
It was which fees do I pay first? So is there like
Which
an
fees
order
do you pay
that
first?
yeah.
Perfect. So we're kind of talking about escrow, like you're getting into escrow, but let's go all the way back to the pre-approval, okay?
Awesome.
So some companies might charge you for a pre-approval, possibly.
Okay.
And what they're really charging you for is like the credit report. So it might be like $25, $50.
Gotcha.
It's per person. So if it's just you on the loan, it's going to be cheaper than if it's you and your spouse. Or if you know, some people will have
A family member?
like another family member.
Gotcha.
So you can have 3, 4 people on the loan, and if so, your credit report is going to be 3, 4 times more expensive. But my experience is that most companies are not going to charge you up front for anything. Okay. So that's pre-approval. You might have to pay something, you might not, you probably won't. Pre-approval. Now you're pre-approved, you're looking for a house, you find a house, you make an offer, your offer gets accepted. Now you're going to put your earnest money into escrow, okay? Mm-hmm. So that's money that you're going to transfer over to escrow, and whatever you put into escrow is going to be applied to your loan, okay? So like if the lender's loan officer's been telling you all along that it's going to cost you, $35,000 out of pocket, and you put $5,000 earnest money in, then when you get ready to close, you just bring in the 30. Exactly. So that's your earnest money. Now this doesn't have anything really to do with your loan because it's just part of the real estate process, but that's your earnest money. So you got your earnest money there. And then now you might get an inspection. Home inspection, right? We've talked about home inspectors. We even did a great on-location video a few weeks ago with Ricky and Anna, and we went through their home inspection and all that kind of stuff. Home inspection is something you as the buyer are going to pay for out of pocket, and the inspection is typically not quoted by the loan officer as part of your out-of-pocket fees because the inspection isn't part of the loan.
Gotcha.
Okay. So sometimes the person will get caught off guard because they got to pay for the home inspection, and that might be $400, $500, $600. Then now we're finally into the first loan fee that you pay up front, and that's going to be for the appraisal. Okay. Yeah.
The home appraisal, right?
The home appraisal, exactly. Gotcha. And you can't do anything about what that fee cost, because it's regulated by the federal government, how the lenders are able to choose the appraisers. That all goes back to that Dodd-Frank thing back in 2007. And so now the appraisers have to be picked a certain way. And so that also did away with being able to choose this appraiser because they're $400 versus choosing this appraiser because they're $600. So you don't have a choice. But that would be the first real loan fee that you would pay out of pocket. Now, once you've done that, there's typically no more money out of your pocket until you get ready to sign the final loan papers and you're ready to go. And then at that point in time, that's when you're going to transfer whatever remaining money is needed. And that's always subject to change until you get to the very end, because there's numbers that are always being recalculated, there's estimates, and then there's final numbers that get plugged in, and there's all these different sources where the numbers come from. They come from the escrow company, the title company, the county recorder's office, the lender's office. So there's all these different things that aren't settled until you get closer to the end. But if you're working with a great loan officer, you shouldn't be coming out of pocket more than you expected, unless the escrow company or the title company is just charging, higher fees than what were originally estimated.
Gotcha.
So anyway, so that's it. So you're going to put your earnest money in. You're going to pay for a home inspection. You're going to pay for an appraisal, and then you don't have any more money out of pocket.
Awesome.
Until you get to the end.
Gotcha.
Yeah.
Thanks for explaining that.
Yeah, absolutely.
That's what I got. I'm looking at these questions and just based off our conversation. Yeah, you pretty much knocked out all of these.
Yeah.
But yeah. I don't know. Covered how many fees are there? Are they negotiable? Yeah, I think
Yeah, very cool.
Yeah,
and
awesome.
I would always say just get, our best advice for you if you don't know someone that you trust that's in the business as a loan officer. One of the best things to do is to just get 3 quotes. Get 3 quotes, compare the quotes, and educate yourself a little bit about what you're looking at as far as the fees and the payments and the loan programs and things like that.
Awesome.
Yeah.
And then should we hop into our viewer question?
Let's do a viewer question.
Awesome.
We got a viewer question, which reminds me, if you're watching this and you've got a question about home buying, you just type it down in the comments right now, and we'll check it out, and we'll answer your question on our next episode. But what do we got for right now?
All right, this week's is, should I use government programs for my lending or just go with my bank?
Okay, cool. So government programs, I'm not sure exactly what the person's talking about with government programs. They may be talking about down payment assistance programs. There are some government programs like California has a program by CalHFA, California Housing and Finance Authority out of Sacramento. It's a great program, and we offer it as well. And it's a program where there's money that goes towards your down payment and your closing costs. It's down payment assistance. There's some strings attached to it. Sometimes there's income limits, sometimes there's lower debt to income thresholds and things like that. So sometimes there's things about it that people don't like, so they go with a different type of loan. But we offer that loan, and sometimes that's referred to as a government program. Another type of government program might be if the city or the county had some type of grant that they were doing to help home buyers. Mm-hmm. So those are examples of government programs. But what the person may be talking about is it government loans? So typically FHA, VA, and USDA, like the meat people, USDA, the United States, the Department of Agriculture. But you have to be like way out, kind of in the boonies, like out in the sticks. Okay. So you don't see them in like Orange County or I don't even know if there's Riverside or San Bernardino really. But so government loans, and the government doesn't actually loan the money. So if you're getting a VA loan, if you're a veteran and you're getting a VA loan, the VA is not loaning you the money. The money is coming from the lender, and the lender is having the loan that they put out, it's guaranteed against losses by the VA. And the VA helps the lender cover any losses from what's called a VA funding fee.
Okay.
So in other words, the VA is collecting a fee on a lot of their loans, not all of them. If you're disabled, then you don't pay the fee. But for everybody else, they pay the fee, and that fee goes into a little bucket. And then if one of these lenders, the loan defaults, they pay some of the loss out of that bucket. And that's the same way that FHA works. The FHA doesn't lend money. They just set the guidelines, and they have this insurance program, and you pay into that insurance program, and then if you don't pay your loan and it goes back to the bank, then the bank gets a little bit of payout from that.
From FHA.
Yeah. Gotcha. So sometimes those are called government loans. Those are government programs. And so, so with all of that said, what was that question again?
So it was gonna be, should I use government programs for my lending or just go with my bank? So I think he's just trying to see, he's just trying to know where to get the best.
Yeah, you know, I would look at, if I was starting out, like I mentioned earlier, I get 3 quotes.
Okay.
I get 3 quotes, and for the loan officer that gave you each quote, I go to each of those loan officers and just ask them to explain the quote and just ask them about the different things that you don't know anything about on there.
Awesome.
And if a government program, an FHA program, is a better loan for you, or let's say that they show you FHA, the loan officer only shows you FHA loans, then ask why they didn't show you the conventional loans. You know, and they may have a reason for it, or they may not. But, and the same goes if somebody showed you a conventional loan, you might want to ask, well, what about the FHA option?
Okay.
And it's really early in the process. It's a really good idea to just be like a sponge and try to just absorb as much information as possible about the loans and the fees and things like that, because you want to make an informed decision before you get too deep into the process. Gotcha. And then you go with someone just because this is the only person you know, and you got to get started today or whatever.
Gotcha.
Yeah.
Gotcha. So look around.
Yeah.
Look around.
So get quotes. That person says, should I do a government program or just go with my bank? What I would say is government programs, if we're talking about FHA, VA, they may be a good fit for you. Talk with your loan officer about it. And then when it comes to the bank part, get a quote from a bank, get a quote from a credit union, get a quote from a mortgage broker, and then just compare those 3.
Gotcha. Because you guys, a mortgage broker, have access to all of, well,
We're
a lot. They have a lot.
Every mortgage broker has access to them. So it's not like it's just us. We are a broker, and we do have access to a lot of programs. But that's the advantage of working with a broker, is that they've got a lot of programs. I would say the advantage sometimes of working directly with your bank, like I bank with Chase, if I was going to do a mortgage with Chase, one of the benefits might be that I'm already familiar with how they work, or I might be, if I wanted to make my mortgage payment in person, I could go in and pay it at the bank or whatever.
Awesome.
So there's different advantages to whatever. If you're with a credit union, you may like the fact that they've got they might give you a special incentive if you have your mortgage payment auto deducted from your credit union checking account. Sometimes, so it's a good idea to check out what your options are.
Gotcha.
And that person may want to go with their bank, or they may end up going somewhere else,
Mm-hmm.
and they may get a government program like FHA, or they may go conventional.
Okay, awesome.
Yeah,
Awesome.
Very cool, great. So again, viewer question, write the question in the comments below. We'll take care of it next week. And
if you guys have any comments, anything, feel free to just drop them down below. We'll go ahead and choose them out, and we'll answer them in one of our videos.
Yeah, absolutely.
Mm-hmm. And then that pretty much wraps it up for this week's episode.
Wraps it up. Check us out next week. We got a new episode coming out.
Mm-hmm.
And if you want to buy a house and you'd like for us to help you, reach out to us. If you want to get a home loan and you'd like for us to help you, reach out to us. Or if you've just got some questions and you need some help with things, you can text or call our office at 949-518-0742. And also be sure to check out our YouTube channel, check out the show. We're putting a lot more content up. And check us out over on Instagram and Facebook as well.
Yeah, don't forget to like, share, subscribe, and remember, comment down below for your questions.
Yeah.
All right.
Thanks, everybody. Appreciate you watching. See you next time.